Welcome to the Crypto Prism channel. Today we are looking at Bitcoin's trend movement. First, let's take a look at Bitcoin on the 4-hour time frame. In the current structure, Bitcoin is still operating inside a complete upward channel. The lower boundary keeps rising, and the upper boundary rises in sync. Overall, this is a standard, trend-type upward consolidation structure, and not a reversal structure. Previously, the price also rebounded multiple times from the lower boundary of the channel, and then moved upward to test the upper boundary. This time, the rebound moved up to test the midline of the channel. But during the first test, it clearly encountered resistance and pulled back. This shows that the midline is the first dividing line between bulls and bears. Buyers above did not break through with strong volume in one move. This belongs to a normal pullback inside the trend, and not the end of the trend dot after the price pulled back. It did not break below the lower boundary of the channel. Instead, after stabilizing inside the channel again, this part becomes very important. The current price is sitting exactly at the Fibonacci 0.382 level and is repeatedly moving up and down around this area. Within this trend structure, this is a very typical mid-trend consolidation zone. From Fibonacci structure, 0.236 is usually a strong pullback level. 0.382 is the standard trend retracement level. Below 0.5 is where trend weakness begins. And 0.618 is the edge of trend damage. And now the price is staying above 0.382 and repeatedly consolidating. The main trend has not been damaged. Funds are rotating positions within the trend structure. This belongs to an accumulation phase inside an upward trend. So why is there a possibility of moving upward to test 0.618 and the upper boundary of the channel? First, if we look at MACD, it has formed a bullish cross showing upward momentum. At the same time, based on structural symmetry and the channel structure, every time the price completes a pullback confirmation, it must at least test the channel midline or the upper boundary. But this round only tested the midline before pulling back. So structurally, it has not completed the move. And looking again from Fibonacci retracement together with the channel confluence, if the price starts rising again from 0.382, then the corresponding midline of the channel is near 0.5 and 94,000, which is also near the previous high area. If the previous high can be broken, the next target would be the upper boundary of the channel, aligning with the 0.618 confluence zone. This area is the triple confluence zone of Fibonacci plus channel plus resistance. In technical analysis, such confluence levels often become the next trend testing target. Now let's revisit the logic of volume and price. The sideways movement is not happening with heavy selling, but with low volatility and low selling pressure, which looks more like accumulation inside a trend rather than distribution. Currently, on the 4-hour time frame, the highs are rising. The lows are also rising, and the pullback did not break the previous low. This means the channel structure is intact. This shows that the main trend is still in an upward trend, with a stimulated pullback, meaning the market is in a corrective pullback phase. And afterward, it is highly likely to resume the next upward push. Using Dow theory, this is closer to the phase of trend push gives corrective pullback, gives continued trend push. It can be viewed as breakout upward gives pullback, gives rise again. So overall, the trend has not been broken, the structure has not been broken, and this area is not a place to blindly chase, nor a place to panic. It is a trend-based battleground area. The bullish scenario is if price continues to hold above 0.382, and breaks out upward with volume from the current consolidation, and then stands back above the channel midline, the natural target would be 0.618, and the channel upper boundary confluence zone. Now let's look at the weekly chart. Last week's weekly candle closed as a doji, a bearish doji. Its meaning is simple: bearish momentum is weakening. Bulls and bears have entered a battle phase. After a downtrend, a doji appears. This is not a signal of continued accelerated decline, but a shift from trending downward to momentum exhaustion, and then into structural consolidation. If the trend were going to continue its main drop, this candle should have been a large, solid bearish candle, not a hesitant doji. Also, looking at MACD on the weekly chart, a bullish cross is about to form. Currently, the bearish histogram is continuously shrinking, and the two lines are curving toward each other. The fast and slow lines are about to form a bullish cross. This is a textbook weekly level rebound initiation structure. Note, the weekly MACD is not a short-term indicator. Once it forms a bullish cross, it represents a multi-week to multi-month rebound cycle. It doesn't necessarily mean A bull market begins immediately, but it does mean the downtrend has ended and the rebound structure has started. Looking again after the price fell from the high, Bitcoin did not continue accelerating downward. Instead, it formed a clear, sideways consolidation structure. This zone has contained many weeks of overlapping candles. You can also see frequent upper and lower wicks, with lows no longer breaking lower. Structurally, this is a standard bottom building pattern. At the same time, the lows are rising, while MACD made a lower low, forming a bullish divergence. This is not part of a trending down phase. The core function of bottom consolidation is only one thing: to prepare for the next rebound, or counter-trend recovery move. The current price, 92,006, is sticking near the Fibonacci 0.236 retracement level, and within the rising trendline support zone. Earlier, price no longer made new lows, which matches the signal of a downtrend ending, and a secondary trend turning bullish. MACD's bearish histogram keeps shrinking. The two lines are curling toward each other, showing signs of convergence, corresponding exactly to the typical structure seen before a weekly level rebound starts. Next, it is highly likely that a weekly level rebound will begin.